All right, hello everyone, and welcome to another Pepperstone live event. Today we're discussing, of course, the live market action that's been quite big recently in terms of the volatility. Obviously, seeing some big moves here in the crypto exchanges and Ethereum in particular, and then of course we've seen some large moves in the major indices, currencies, etc. Now, in terms of what we're covering today, of course, it's going back to a little bit of basics: support, resistance, and moving averages. How can we use those to better understand basically levels where markets come back to, what else we look for in terms of rotation, how we can use higher timeframes to analyze these markets. My name's Thomas Atkinson, as always, joined by Tyrone. Tyrone, how are you going this week?
Yeah, good, thanks, and welcome everybody to tonight's webinar. Sorry we had a couple of issues starting a bit late, but we've hopefully sorted out those gremlins now. The market's been
Yes.
really interesting over the last week. Looking forward to getting into, I think, some key points on some of the indices and also a couple of the majors in the currencies as well. So yeah, looking forward to jumping into those.
All right, well, let's get started here when it comes to the markets. And of course, we're going to talk about moving averages to start off with. And why I wanted to mention this is because, of course, we always talk about the 20 moving average, but there are other ones that you can activate on your charts. And what I thought we'd do is we'd add some to our technical analysis chart here inside the Pepperstone TradingView platform to really go through some of the ones we like the most. Now, what we're going to do is we're starting here with a 20 exponential moving average, which you can see here. And if we then move to another one, so if we go to another level here, so we'll add another one here, and we will go and add a 50. Now, Tyrone, we like 20s and 50s, don't we? So we have a 20 moving average, we have a 50 exponential moving average, and we generally have a 200 simple moving average, don't we? Now, why do we like the exponentials a little bit more for some of the faster moving averages? What's the reasoning behind that?
Yes, so we love the exponentials because they're a little bit more reactive to price. Now, it does come with a little bit of a trade-off that sometimes they might give you a more false signal, but really, for the most part, they're far more reactive to price. And exponential effectively means that the moving average is weighted more to the current price action than it is the overall. So, as an example, if you were looking at a 20 moving average, the exponential 20 moving average is using the data from is giving more weight to the data from the most recent candles of the last 20, where the simple moving average is just an average of the last 20 candles. So the exponential is really good for the 20 and the 50 because it gives you a more dynamic and reactive movement and support and resistance. Really, the dynamic nature of them is a little bit better. That doesn't really work as well for the 200 moving average because it's so big. Adding extra weight to the front end doesn't really assist us. And for the most part, the 200 moving average is an extraordinarily important moving average worldwide. You see them talking about it on the news and in a lot of newsletters when majors cross it or it crosses above. So you really want to keep that moving average as a simple because that's it's actually a gold standard moving average for many investment firms. Really, it's good.
All right, so basically we have, three different moving averages we like to use. We usually set them up as a color: red for the fastest one, blue for the second, which is the 50, and then green for the simple. Now, the one thing about the 200, which is the green one here, we'll get rid of this anchored VWAP so you guys don't have to see it. Basically, this is often considered kind of the yardstick for trend. So a good cheap method whenever you're looking at any currency, any index, any pair really, is to go to the daily time frame and then always to select here, what are we looking at in terms of, is price action above these levels or not? So you can see here that we have the 200, and if price is above that level, then we need to be paying attention to it. I actually do think I put the VWAP on. So let's add that one more time. So moving average, we're going to add the simple here. So we only want to have the simple. And what we'll do is then we're going to change that to a green simple moving average, 200. And we're going to change that to green, make that around this thickness is usually the good level, I feel. And what you'll notice is that the market has predominantly been since probably around January of 2023, above the 200 simple moving average. And this is a good yardstick that generally when you're above, you should be more looking towards the bull end. And when you're below, you should be more looking towards the bear side of things, yeah? So it's really important to consider that when you're looking at these markets. And of course, we always want to be paying attention to those types of things. Let's move over just to a currency, and we'll have a look at the euro US dollar, for example. and we're going to go to the daily. And what you'll notice that for quite some time, and again, that we have a lot of anchored VWAP on here because we do like anchored VWAP, but what you'll notice is that for a long time now, if we have a look at this simple moving average, the market has been underneath it, but also you may notice that it's been kind of flatlining. Now, what does a flat moving average tell us about price action tie, especially when it comes to the 200?
Well, it tells us when it's flat, there is actually no real bias to the direction of the trend. Especially the 200 is a bit of a, I mean, really, a lot of big investors trade underneath the moving average in a shorting market and above the moving average in a long market. But when that moving average is going sideways, especially the shorter ones, it's showing us that the market's actually going relatively sideways without a big trend. And that's generally the best way to follow it. Now, there are examples like when a market sees a really, really big move, like we've seen in a couple of the cases over the last few months, it can flatline. The 200 moving average is a slow moving average, so you've got to remember it's very, very slow to react. So if the market has a very, very big move very quickly, even if it moves several hundred points or big percents, the moving average doesn't actually catch up anywhere near as quickly. But the smaller moving average, when they're going flatlining, is generally telling us that there's either consolidation in the market or there is no significant trend.
And that's really important to recognize these periods of no significant trend, which means that you should be faster and sharper in markets versus significant trend when you've got basically markets moving in that direction. So if you have a look over here at the point here of 2021, when we saw a significant decline in the euro, we obviously had this very good read of when you should be mostly bearish towards the euro, when you should be mostly bullish, again, price above it, and then mostly bearish. And then even as it crosses over the first time here in 2023, as it crosses over it, you wouldn't know at that period that it's a sideways kind of market. You would be predominantly bullish and predominantly correct until it crosses below. And then you start to see a flattening of those moving averages straight after that. Now, when you see that flattening, that's a warning sign and basically something to tell you, okay, let's chill. It's all good. So we need to know now that we're not in a momentum-based, real move, and therefore we should keep it faster and quicker for our TPs. It's a great tip, and when you go through your pairs, you're going to see whether it's a stock like Tesla here, when it's above, like recently, crossed from below to above the 200. We didn't really want to be bearish as of that point. When you've been above it in the past, such as over here, you wouldn't really want to be bearish. And it can act not only as a good indicator like that, but you'll notice here in this stock, being Tesla, you'll see it act as a dynamic support and a dynamic resistance. Now, Ty, we love using moving averages like this, don't we? Because really, in essence, the main power of a moving average actually comes from the dynamic support resistance side, doesn't it?
It does. And I think, Tom, you can go to any instrument. It doesn't matter whether it's a commodity, a stock, currencies, indices, and go through the different time frames. And we could show you hundreds of examples every single day where these moving averages are a dynamic support or a resistance point. And many strategies can be built around those, just simply using them as support and resistance. So that's why they're extraordinarily important to the way we analyze the markets. Now, you might also say, why do you use the 20 and the 50? Look, we've experimented over many years with many different numbers, and there are many different moving averages you can use. Basically, any number you want, you can use. But we found the 20 as a rule is an average of how many days there are in a month, on a daily in particular, obviously, how many days there are in a month that are tradable. So, weekdays in a month. And for the most part, you're generally going to get around 20. That has made the 20 moving average a very, very important moving average. Now, of course, on smaller timeframes, it doesn't actually equal the same thing if you're on a daily, but it still holds that stigma. But also, probably just as importantly, it is regarded as the mean reversion moving average. So quite often, that's why it's such good support and resistance in a downtrend, because it is the mean reversion, effectively the mean reversion indicator, where price, when it is looking for its consolidation, even in those moves, it pulls back to that level, whether it's in a downtrend or whether it's an uptrend. So it's a very, very important moving average. In fact, our favorite. The 50 acts as a buffer zone in a very, very aggressive trend when pullbacks are a little bit more volatile. Sometimes it can go through the 20, but the 50 is almost like a catch-all, where if the 20 fails, quite often the 50 will hold up as long as the trend is intact and true. If it breaks both, then yeah, the trend could definitely be in trouble. That's where you've got to really take care. But the two work very, very well together.
All right, so let's now have a look here at what's going on in this current market. So US 500, obviously the 20 moving average has been the yardstick for the deeper pullbacks. We haven't seen one of those since realistically this period over here, which is in September. So, the question will be, when will it come back and touch it again? As Tyrone mentions, it's one of the best in terms of mean reversion. And if you go to any good bull market run, whether you're looking at the 2020 to 21 period, or even going back to the 2016 or 2014 runs, what you'll notice is that we get a lot of hits to this 20 moving average and we see a lot of dynamic support. The 50, as Ty said, is the buffer between them. And if you ever lose the 50, especially on the S&P 500, it often then falls to the 200. It tends to be, not always. Obviously over here, we could see it was kind of weakening already, but the 200 did come soon after. And the 200 is a significant pullback. Usually that's getting you close to kind of like a bear market kind of situation. So when we're looking at these markets, it's best to always come from the top down. We like to start usually on the weekly or the monthly. Then we kind of come down and we have a look at where we are right now. Now, you may notice that we're seeing a little bit of a sell-off this week, just a few little percentages, not much at all. So from the high of 6,100, we've fallen about 1.12%. Now, that's to be expected. Eventually, you're going to see pullbacks. And little known stat is that during the month of December, we see a lot of mutual funds kind of doing their books for the end of the year. And that tends to mean they sell up a little bit. They do a little bit of rebalancing. And often we do see this kind of downward pressure as people take profit on some of their stocks, trying to bank those bumper profits for, of course, their Christmas bonuses. Now, in this case, we've seen a couple of things interesting in the last couple of months. The 20 moving average has acted as dynamic support twice, the 50 once, then the 20 again in this current run. So this would mean that if the market comes back down to around the price target of 6,000, then we could be looking at a pretty good support level, couldn't we? So this could be a very interesting support zone and certainly well worth paying attention to. Now, there are other things there because, of course, today we're talking about support resistance and even bringing in a little bit of a supply demand. Now, Ty, we like the idea of role reversal, don't we? So that is where resistances become supports and then supports kind of hold up, ideally, when you have other levels of confluence. So with the 20 moving average at around 6,000, the psychological level of 6,000, and of course, the potential here of a role reversal zone on support resistance, would we start to really be looking at the smaller timeframes if the market was to get back to 6,000?
That is such a key level. I've got that marked up for about 5 alarms, Tom, because I think that you're right. The role reversal at that level and the 20 moving average. Look, the market's actually, we've been talking about it in our streams all week and even last week, that the market is actually pulling back at a rate where it's allowing the moving average to actually catch up, almost like it's a self-fulfilling prophecy. Because what you don't want to see, again, moving averages can be a little bit slow acting. So what you don't want to see is a sharp candle fall 100 points and go straight through that role reversal. But the fact that it's actually coming down in a very orderly fashion is allowing the moving average to catch up. Now, that's a double buffer zone, so it's double support. And knowing that the 20 moving average is a key support zone for it, it does add a lot more weight to what we're seeing there. And you're right, the minute that happens, we don't automatically place a long buy there, of course, but what we're looking for, we're on the lookout on the smaller time frames for any clue that the market's going to pick up from that level and potentially push again to new highs. So yeah, we're looking for double bottoms at that level. We're looking for higher high, higher low sequences on the smaller time frames. Anything that's going to give us a clue that the momentum is going to actually hold up at that level. But I think it's an extraordinarily important zone, and I think one is approaching on the NAS as well at around there's a few key levels actually on a few of the world indices that are having a very similar attack.
Let's take a look at the NASDAQ then. So again, the same type of thing, the 20 moving average holding the first two, the 50 holding the second, albeit kind of like a slower moving move, and then the 20 kind of just being broken through a little bit more recently, then holding, and then of course now we're not there yet. Now, this is a classic, again, of resistance becoming support that Tyrone mentioned here, which is basically where we get back down to possibly a pretty key zone, I would say, around 21.1 to 21,100. And they should all synergize together. We often talk about this. Like in markets, it's really important to note that if the S&P 500 is finding problems, like that is that we see resistance there, generally means that the NASDAQ will as well. And the reason behind that is, of course, the NASDAQ pretty much S&P is like 25% of the main mag 6, 7 companies are kind of the S&P right now. So they're kind of moving a little bit more in uniformity than they used to. That's what we call a concentrated market, isn't it, Ty? But still, if you were to
Absolutely.
pick, which chart would you pick? I mean, would you generally be picking the S&P as the better yardstick in terms of moving averages?
Um, I think they actually look. You know what? The thing with the Nasdaq is it can be a little bit more aggressive in its moves, just in the tech nature. Sometimes they can sort of go through the moving averages a little bit sharper. I think the S&P
Yep.
is probably the best for it. I think the indice on the S&P is my favorite because I think it's the one that everybody sees. I think it's stronger than the Russell. It's stronger than in terms of holding levels, and stronger than the Dow, of course. But I think that's because of its stable nature. So it's definitely my pick. Probably closely followed by the NAS and then onto the Russell if I was going to put them in an order, I think.
Okay, so we've got S&P first. I would agree S&P is usually the best one for me. So anyway, we've got this 20 moving average that kind of sits on both of them. Now, let's just talk about how we could possibly trade that if it does come down and use moving averages to a degree again. Now, if you're going to use smaller timeframes, once, of course, when you're using as dynamic support or resistance, what you'll notice is that we're always going to get crosses, of course, to the downside on the smaller timeframes. You go to a 2-hour, one of our favorites, a 1 hour, a 15-minute chart, any of these things, you're going to see this market kind of decline into these areas. Now, if we have a look over here and we kind of think about what's going to happen if it comes down to this point, what we're looking for is we're looking to have patience and obviously a reaction from those levels. Now, some of the reactions that we can get at these zones are, of course, in candlesticks. Things like a bullish hammer is often a well-considered candlestick. We can also get engulfing candles, which basically means that the bullishness, that is the reaction, is bigger than the bearish candle that hits into that zone. That can also be a good turning point. We can get what we call the lightning bolt, which is obviously a low, a high, and a higher low that then sequences potentially moving off it. The reaction is probably the key for the technical analysis trader because we might be stacking a lot of evidence, Ty, but that doesn't mean that the 20 EMA is going to hold. It could melt it like butter and go towards the 50. What is likely, though, is that one of these two, based on prior evidence that we're seeing in the markets, will find a buyer, whether it's the 20 or the 50. We've seen the 50 do it and the 20 do it, and they've almost been perfect on those dailies, haven't they? So we always
Yep.
build a confluence, we see the touching of those zones, and then, of course, we look towards the buyers off those levels. Now, if we are going to do that, again, market structure is key. If we have a look last time, this is basically the zone. You'll notice the 200 kind of starts to sync up pretty nicely with that on the 2 hour with the daily 20. But let's have a look here. So we get that kind of low, then we see a nice wick. That wick tells us that the market is finding buyers, and then the rest is history. We end up coming up. If we have a look at the previous time it touched the 50, which is over here, again, we see a significant low. We see a bit of a rally. It goes on and takes a new lower low, which is a pretty classic kind of thing for the market to do, and effectively creates a double bottom. Now, if you've ever done our ultimate masterclass or anything like that, you would know that we like to stack patterns. That is, we like to stack price action recovery within trend. We know the trend's up because we looked at the 200 on the daily and it was up. We also know that if we get a reaction in a form of a double bottom, that's one of the classics, I guess you wrote into the ultimate masterclass, didn't you, Ty, in terms of one of the favorite things that
Absolutely.
you like to see when it comes to trend change.
Absolutely, absolutely. And the good thing about the moving averages that we're talking about is they are all completely interchangeable. So once you master the art of what you're trying to achieve with the moving average, you can transfer it straight down to the smaller time frame. So say we're using them on a daily, exactly like we would use them on a 15-minute chart or a 1 hour chart. The minute you see price trading above them and a series of high highs and higher lows where they're pulling back to the 20 moving average on that time frame, you're actually trading them the exact same way. And I think that's why they're so powerful, because they're completely interchangeable between the time frames that you're switching between, but you're also using the power of the prevailing trend or a prevailing level of very heavy support or resistance to base where your entries are going to be. So I think that's probably the easiest way to explain it, that they're very interchangeable in terms of how you trade them. You don't really change.
Okay. All right. So we've got the same thing that we can do all over the place. Now let's go to another one and check out maybe the dollar is a good example of this. So let's have a look at the US dollar. And what we'll see, and we've been discussing this on the channel for a little while as we've been doing these live analysis. And what right now we'll start ripping through quite a few of these pairs to show you this replication concept. So firstly, what changed? Well, we saw that the market was finding dynamic resistance at the 20 moving average the whole way down. It had a trend line on the way down and it broke to the upside. Now, when that occurred, that's pretty significant. We basically saw a huge change of trend towards the upside. And if you then go and break that down, you can see here that we've got a 20 moving average being hit once and found a buyer. Now, that's going to make it so that as traders and investors, we're very interested in how does it react the second time to this level. Now, classic kind of thing that you were talking about before, Ty, is the double bottom. And we're starting to see those signs. So although we might say, oh, it's a possibility of the dollar going weakness here, it certainly is. If this level, this little alert level, and this is sitting at around 106.80, would you say, Ty? Key level?
Yes. Yeah, absolutely.
Yeah. Okay. And would you say that to you looks like kind of a double bottom?
I think it's indicating that it is. I like it. I think what I like about it on the smaller time frames right there, you can actually see that we're getting the sequence of higher highs and higher lows that we're talking about inside the bigger double bottom pattern. And that's what makes it so powerful. The fact that you can see we've already got a higher high, higher low sequence happening and it hasn't even broken the neckline yet.
Yes. And if it does break this neckline, what are you thinking about price action in that?
I think it's a possibility that's going to reach the previous high at 1.7, probably 80. And I think that's a really good target to go for because we love patterns that actually prove themselves from the previous resistance point, as it does in this case. So, yeah, basically where you've got the blue line there, I think it's a very, absolutely, that is a key level to aim for. And it's showing momentum that it could potentially get there very easily.
Yeah. Yeah, I would say this is certainly a classic kind of resistance breakout. Now, generally speaking, we would like to probably see this close on the daily above. And then at that point, if that occurs, even if it pulls back, you'd have to think the momentum is in bull's favor, wouldn't you? We're above the 200 on the daily, so obviously the trend is theoretically still up. We've seen the kind of rejection here at the lows. We've seen the breakout to the upside. And of course, we've got the trajectory of where we think it's going to go. Would you agree that those are kind of starting to look much more in the favor should we close above 106 kind of 80?
Yeah, most definitely. I really like what the dollar index is doing. We have liked it for a bit now that the price action is playing the game exactly how we want it. Now, look, it might be a good time to touch on the euro. Actually, can we switch over to the euro because it's the exact thing that in reverse, of course. So what we're looking for here is shorting opportunities on the euro, but I think this is a classic case of how it's smashed straight into the 20 moving average, like we've been talking about, and forming a double top in the direction of a prevailing downtrend. And I think that's key. We've done a lot of research over many years now to identify the best way to trade double tops and double bottoms. And without a doubt, the best way to trade them is to make sure that you're trading in the direction of a prevailing trend. Now, both of these are in prevailing trends. As you can see in the euro there, we've got obviously a big series of lower highs and lower lows on the daily and a potential double top happening. But the 20 moving average was at the top of the second peak, and it's really significant, especially in the context of what we're talking about today.
Yeah, I think this is resistance. It's so many different things that we've got going on. And again, it's going to sync up well with that US dollar. So let's then go through and have a look at silver. So silver's been a pretty good little bull run here off the last couple of weeks. We've been discussing it. Now, silver hasn't really been showing the same level of dedication towards some of the moving averages. And what I mean by that is this is why it's important to proof it with the left-hand side. Have you seen respect of those moving averages on the pair in recent times? So while sometimes you'll see the 50 and the 20, and this is what we call a ribbon, where you've got the 20 and the 50 crossing and it comes back up. Now, the cross, of course, signifies weakness here in this case. And when you've got both of them stacked on top of themselves, some people believe that's better dynamic resistance, e.g. over here. But at the same time, you can kind of see, yeah, the 50's been respected. Sure, the ribboning component has been respected quite a few times, which I think is key. But in essence, we don't really have that dynamic support or resistance being shown on this chart on the left-hand side. So therefore, in many ways, while I still like looking at this, at the moving averages, I would discount them a little bit more. It's important to understand, is that particular pair respecting your instrument. Yeah, if you're using an indicator such as moving averages, should you always use it? Yeah, you should always consider it. But I would argue that if you look at this chart, we just haven't seen that respect of the moving averages. So therefore, what we might do is we might say, okay, well, all right, we might not be able to use our moving averages, but let's at least consider the support resistance side. So here again, role reversal, kind of like the classic resistance over on this side, support, 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 support. Pretty good support, I would argue, Ty. Pretty good support. Double bottom pattern. Okay. So again, that classic
Absolutely.
pattern we've been looking at before. Now we get the double bottom pattern, we see the breakout, and admittedly, if you think about this little component here, twice it respected the daily 20, so you could possibly start to consider it this time around. But I think more importantly, it moved above the ribbon, which is something that we had seen before be an important kind of resistance point, such as here, such as here, such as here, et cetera, et cetera. So therefore, when it broke through, we're going to say, okay, wait a second, we could start to turn bullish on the small timeframes. And that was only just the beginning of really the analysis. You can actually go quite deep into silver over the last couple of weeks, and we have done so with different techniques. But you'll notice that we started to turn bullish on it. And the mixture of kind of like inverse head and shoulders here with the pattern, it's a mixture of understanding that we're on a trend line of the bigger timeframes. It's a mixture of course, breaking above those ribbon patterns and the daily close and those types of things. And of course, just generally seeing the overall, which looks like someone could be accumulating the position that can help you as a trader to better understand what you want to do on the smaller time frame. So again, if you're a day trader, if you're a scalper, this can be quite helpful.
Absolutely. And I think if moving averages serve no other purpose than to just give us dynamic support and resistance, but also give us the knowledge that the market is actually moving. Because like we said earlier, when they're ribboning, it's basically indicating that a market is flat and not moving in a direction. And that requires a completely different mindset in how you're going to trade it. So if they give us nothing else other than a direction and also a way to know that momentum is actually moving in a particular direction, that they've done their job. There's so many ways that you can apply them, but I think what you want to do is keep them as simple as what we've talked about tonight, and that is to really highlight where their best use is. Firstly, to tell us that we are actually in a trend, be it down or be it up, but just as importantly, giving us that dynamic support and resistance. That standard horizontal support and resistance just doesn't, it just doesn't give it to us. When you can combine them though, and I think, well, that's probably the perfect thing that we're talking about, really. When you look at the S&P, I'll go back to that for a second. When you look at the 6,000 and you say there's static support, obviously, that we know about, no question about that at 6,000. It's also a round number, but the dynamic support is fast approaching as well with the 20 moving average right there. So you're getting dynamic support and static support bolstering that level, coupled with an extraordinarily important round number and a significant zone for that particular trade. So, you would have to be looking at that and saying, well, this is an area we are definitely going to pay a lot of attention to when it comes down there. Now, is it an automatic buy when it touches it? Absolutely not. But is it an area where we're going to those smaller timeframes like we just saw on silver and start to look for those moves to actually give us an indication that momentum is shifted and it's going to start to go up? Absolutely.
Yeah, so I think we've got to like that zone. We've got to like the overall confluence. And Ty mentioned the psych supports. Just remember, never discount these psychological numbers. If you actually looked into it further, you'd also find there are a lot of puts there. So in the options world, there are a lot of puts on 6,000 as well. That makes sense. I mean, humans love round numbers. I always go back to the thing of, would someone want to take, let's say Apple, the first time it ever hit $100, would a person want to take $100 as their target? Or would they want to take $99.90? Generally speaking, Ty, they'll always take 100, won't they? And that's the advice world. That's just kind of what happens when it comes to general human psychology. If you said $99.90, I would say most people would never want to take that price. Yet that's probably the better price. And that's why actually when you saw Bitcoin recently, notice it got close, and Ty called this, and so did I, in terms of we didn't feel like it was going to hit 100. It was either going to get really close and sell, it did, or it was going to absolutely blitz it and then go like 110 straight away. So in this case, it was very unlikely to kind of just sit around 100, 101 the first time. it was more than likely going to probably sell just before. And that's exactly what it did. It eventually, of course, did go back above, and now it's consolidating around, what is it? A key number. Now, why would it
Absolutely.
consolidate around a key number? Because people are taking profit, aren't they, Ty? There's no way that some
Absolutely.
people haven't set 100K as their take profit zone, including some people on Wall Street.
Oh, most definitely, most definitely. And you know what? The funny thing about that is, yeah, it was almost at the time it seemed actually ludicrous when it was sitting around the 20 or 25,000, sitting around 25,000, and people were calling 100,000 then, and it almost seemed outrageous at the time. But by golly, it got there, and it's been. And we said, I think we've been saying for quite some time, Tom, that when it was trading underneath 70,000, we did say that when this thing breaks out, there may be no stopping it until it reaches a significant high. And certainly, and it did it in a very big hurry. Yes. Did it have election help? Did it have a change of government, or government hasn't even changed, but it had things that were actually assisting it? Yes. That's how the markets work. News often works for the most part when technicals are in your favor. News or events often actually help you get there too. And that's what it did with Bitcoin.
And classic case of dynamic support being held so far. And this is why, that it's important to note that if you're a scalper, you'd want to be looking a lot around this current price action we're at right now, 20 moving average. Why? Because it's supported it the whole way through that breakout. It kind of brings me also to Ethereum, similar type of thing. Breaks out. Again, we want to look at the left-hand side and understand, have we ever seen respective moving averages through this initial breakout run? So you could argue that this is the kind of point that you're at, an initial breakout. 20, 20, 20, 20, 20, 20, 20, 20, 50. Okay. And then it goes up. And then, of course, it just kind of hovers around that support. And then it goes back onto respecting 20, a little bit up here as well. And it's here. Then recently, 20, bounce, 20, bounce. And we're currently there at a 20. So could we see a bounce here? Certainly, it's a case for that. So, of course, if you were going down to a smaller time frame, then you would start to say, well, do we have support resistance? So you've got previous resistance, currently support, 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 and you've got kind of like an intervening trough at around 37,800. So, 3,800-ish kind of level. So again, it's another one of those classics, isn't it, Ty, where you've seen a reaction off this level, yeah.
Absolutely. No, I 100% agree. And I think that understanding it and being prepared for it. I think never truer a word or a saying that we have on that chart all the time: patience, react, don't predict. Being prepared for what is about to potentially take place, just like playing chess, being having your chess pieces ready to go. The market's going to make the move, and you need to be ready to actually work with it or counteract it. But what you don't want to be doing is trying to guess it. That's where you're going to come unstuck. Many a good trader have fallen for that trap. And realistically, we talk about this every single Wednesday. We're given so many different tools and opportunities to actually predict good levels and work with them. We would be mad not to be taking advantage of those. And I think understanding them, it becomes second nature, definitely. And we've done many videos on this. You go back through the YouTube channel for Pepperstone, and you'll see many webinars and videos where we go specifically into detail on how this works. But in a nutshell, this webinar tonight actually goes a long way to explain it, because it is really as simple as how we've explained it.
Yeah, you don't need to overcomplicate things. You've just got to say, okay, do I trust these moving averages have worked before on this instrument? We proof it by looking at the left-hand side. An excellent way of really doing it. I would say probably 95% of technical analysts don't actually look at the left-hand side to see how things have actually worked in the past and whether it's recently been respecting that kind of level. Very important to do so. Similar situations, has it been a pretty good indicator? If it has, then that's good. Then, of course, coupling it up with psychology, so psychological numbers, and, of course, support resistance, supply demand, anchored VWAP, and some of the other things that we've used. I'd like to hand it over some questions because, of course, we've covered a few pairs here, but do you guys have any questions that you want to ask about these instruments or how we kind of look at this analysis? And while we're doing that, I just wanted to look at another pair. So ask the questions now and just kind of show you here why you've got to do that left-hand side analysis before you do anything too crazy on charts. Now, this is US oil, and you'll notice here that there hasn't been actually some respect here of these moving averages. It's probably really more on this side over here. The 50 has been respected recently, which you can see by doing the 1, 2. Now, the reason I bring up oil is because I really love using the 1 plus the 2. So if we use both of those together, then of course we can analyze it more correctly. Say the 1 plus the 2, we've seen it happen twice. Why wouldn't it happen a third, a fourth, a fifth, and a sixth time? Got a good question coming in here and says, should we use any other moving averages, Ty? And look, you can. Another couple that I guess people use, the 5 and the 8 on the smaller time frames if you're a scalper, and then also the 100 is quite well used in the industry. Some people use the 21 instead of the 20. Don't worry about it. They're basically the same thing. 21, 20 days. It doesn't really matter. So any others that you can think of, Ty, that you think are better than those?
No, look, a lot of people like Fibonacci numbers, but I really want to stick to what everybody else is seeing. And I think you can overcomplicate it. Sometimes if you put too many moving averages on your chart, you end up having your bias dictated to by analysis paralysis, I think. I think that the 20 is very, very sound. I would stick very closely to just sticking with the main ones. That's my personal opinion, and it's served us very, very well over many years.
Okay, all right. Well, I agree with that. It's pretty much just about keeping it simple, guys. Dynamic support resistance, look at the left-hand side, have patience, react, and predict. We've given away kind of a little bit of evidence there that maybe you should start to look at patterns with the reaction on the smaller time frames. Inverse head and shoulders, double bottoms, double tops. Excellent. Euro, good one to watch. Dollar, good one to watch. Obviously, the reaction of Bitcoin, Ethereum, and even the S&P 500 and NASDAQ should they come back down to these levels. As always, guys, we do this here every single week, so make sure to check us out next week by clicking on the links in the description down below. And obviously, we appreciate your time very much, so thank you for joining us here today. And we'll see you next week to go through live markets and, of course, give away a couple of tidbits on technical analysis and, of course, what provides you edge in markets. Thanks so much for watching.
Yep. Next week's actually our last one, so we look forward to seeing you there. Last one for the year. And then, of course, the Wednesday after that is Christmas. So, good luck with trading. If you are trading this week, just be mindful that we're entering into potentially a seasonally solid time as well. So just know that we can see a little bit of growth in December. So keep an eye out for those little signals on the smaller time frames. But we'll see you all next week at the same time. Thanks very much.
Excellent. All right. Thank you so much, guys. Thank you for joining us. We'll see you next time. Bye for now.